Hey, good afternoon, everyone. Hey, thanks a lot for coming out this afternoon. And what I'm going to be presenting to you, I think, is a little bit of a different way to trade options, something that you may not have seen before. And let me introduce myself. I'm Mark Sachs. I'm with Right Line Trading. A little bit about my background. I graduated from the University of Pennsylvania. I'm a former professor at Jefferson. And I've been involved in the financial markets for over 20 years. And I began trading futures and forex really closer to 20 years ago, around 1997. And what we do at Rightline is we optimize closed systems via the use of mathematical modeling, and that's what I've been involved in mostly in the last 10 years. I started an options portfolio for the company back in 20 the end of 2016, and I'll talk about our performance in 2017 and 2018 and show you a lot of our positions and show you how I looked to take options positions. And I just threw this slide in because I think this really might resonate with a lot of traders in the room if you're here. If I can't open up my Facebook feed without seeing about 1 million people advertising for options trading. And it's probably, and you may have the same thing because they have a cookie on you. They know you're interested in trading, and so they just hit you with every single ad possible. And every one of them is telling you how you can make $1 million trading options and have recurrent monthly income and get 90% of your options trades right. I've seen advertisements how to get 50% wrong and still make a fortune. And so it can be very frustrating. And many of you may have subscribed to an option service, took their trade recommendations and lost money, or you may have hired an expensive mentor and paid his fees and took his trades, and then you lost a fortune. And you've really come to the right place because I make money for my clients. And the thing, I call them clients, I should call them traders, because the thing that's a little bit different about the service is that every single trade I recommend, I take myself. So this is actually my investment portfolio. And therefore, I take a very sort of aggressive approach towards trading options. And that what you're going to see is that we hold a diversified portfolio of options from between 10 and 15 positions at any given time. And the portfolio is always hedged, so that on a day like today, where we still had a down day for the net equity in the portfolio, we had positions that anchored the portfolio and went up and really mitigated our losses. So we really hold a diversified portfolio, whereas I think most options services and most options mentors tell you to go in for a trade and then get out. And I don't look to take really short-term trades. I don't day trade options. I swing trade options. And I'm going to show you everything that I do and how I do it. Now, it is true that 80% of options traders consistently lose money. And the promise here is to reverse the flow. And obviously, why can't 80% of those losers give their money to you? And I'm going to show you how I do it. I mean, last year in 2017, 78%, I had 133 closed positions. 78% of them were winners. And in my personal portfolio, where I took every position I recommended, I was up 105% at the close of the year. So I more than doubled the amount of money in my portfolio over the course of 2017, which is really outstanding. Now, I know that there are other services that tell you you're going to make 50% a month or 28% a month, but to double your money in a year is really quite good. Now, I just wanted to talk about trading options for dummies because it's really a good book. And if you want to learn the options metrics, what is an iron condor, what is a butterfly, what is a credit spread, a debit spread, learn those configurations and what those metrics are. This is the book you need. I mean, it really gives you the nuts and bolts on all the information you need for the numbers. But it doesn't tell you the strategies, and it doesn't teach you how to get into profitable options. And that's really the key to trading profitably. I still like that book, though. Now, the book really gives a lot of weight to the Greeks, which are important to some extent. And then it goes through vertical positions, horizontal positions, butterflies, iron condors. They all have their place, but you're going to see that I like to keep it simple. In almost every position I take is either a debit spread or a credit spread. I take a vertical spread. It doesn't mean that horizontal positions and a lot of traders like butterflies. A lot like iron condors. I personally don't use them. Now, if you ask yourself, if you have a bullish take on a stock and you want to create a bullish position on options, you have the opportunity to create a debit spread or a credit spread. A debit spread is a bull call spread, and a credit spread is a bull put spread. Now, both spreads have the exact same metrics, and which one is most advantageous for you to utilize? And a lot of traders will not know this. And this is why this is some basic stuff, but I think it's important for you to know. Now, if you're going to, excuse me here, on the bull call spread, you're going to create a debit. So you're going to create that when implied volatility is low and the option price is cheap. When the option price is cheap, you want to buy the spread and you're going to pay for it. When implied volatility is high and the options price is expensive, you want to sell it and you want to take the premium on the trade. So you're going to see in what circumstances it's better to take a debit spread or a credit spread. And usually if a stock is taking a big fall down, and I'll show you one of the positions we have in our portfolio where it got a stock got a haircut on really superlative earnings. It beat consensus earnings. It had great forward-looking information. It still fell a lot. Well, it skyrocketed volatility, increased the value of the puts, so it was really advantageous to sell them and to take the credit. Other times, it's a lot better just to buy them when they're cheap. Now, I'm just going over some real basic stuff. Now, if you can, obviously you can buy a put or buy a call. You can buy it out of the money and at the money or in the money. And if you buy it out, now I've heard a lot of traders say to never buy out of the monies, but I completely don't agree with that. There's some instances when buying the out of the money can be very, very advantageous. And some of the most lucrative positions that I traded in 2017 were deeply out of the money. Only they were 8, 9, and 10-month long options trades. And I will take those, and I'll show you one that I currently am holding. They're very inexpensive. They have a low delta, which means for every dollar the stock goes up, the value of the option is only going to go up a small amount. And they have a high theta, which means that their time decay is going to be higher. So what you're doing is you're paying a little bit of money for a potential high reward trade. Now, at the money is moderately priced. The delta is a lot better. For every dollar the underlying stock goes up, the value of the option is going to go up a lot more. And you have moderate theta. So that time decay is going to be a lot better than out of the money. And this is a more expensive option. So you're going to pay more money and your reward is moderate. And then in the monies are really expensive, but you get a very high delta. Just a small move in the price of the stock can skyrocket the price of the option. And you have a very low theta. So over time, these options are going to only very slowly decay. So these are high risk, high reward trades. You're paying a lot to potentially make a lot. Each of these has its place. Now, what I'm going to go over now is how to, the real key is how to find the best stocks, obviously, that lend themselves to the creation of successful options positions. Then there are certain stocks that you want to avoid at all costs when creating options position. And then there are the role of the Greeks and the spread configurations. And then the key also is risk management. Now, I said rate and degree of importance, technical analysis and fundamental analysis. I have to say between the two, for me, fundamental analysis is more important than technical analysis, although they're both extremely important and they vary in importance from trade to trade. And I'm going to show you a trade I took on Microsoft, which it's an open position. I took it pretty much based solely on technical analysis. But in a lot of trades that I take, and they're going to be the trades that you're never going to see another options trader take, because they're based on a lot of research that I do. I'm going to show you how I do it. And it's all based on fundamental analysis. And that fundamental analysis can drive the underlying stock up an enormous amount. If you simply obtain information that's just generally not well known or generally not appreciated. I'm going to show you a position like that right now. So they're both important in general. I believe fundamental analysis is more important than technical analysis, but it does vary from position to position. And we're going to do a lot of technical analysis in a minute as well. So what you're really looking for is a stock catalyst, something that you know is either, in these particular cases, these are things that are all going to drive certain stocks up, or most stocks up. I take very, very few bearish positions. I think they're very tough to win on. But here, the new administration Trump is going to cut corporate taxes. He's going to pump up defense spending. He plans on doing infrastructure spending, and that's anticipated. He's gutted business regulations. Interest rates will be increasing. These are all fundamental metrics that you have to take into account when you look to buy a stock. And it's going to move certain stocks up, and it's going to move certain stocks down, like consumer staples, like General Foods. Stocks like that have been just doing horrific. And so there's certain sectors that you have to stay away from, and certain sectors that you're really going to want to focus on. And this is going to tell you how to do it or where to look. Now, these are specific catalysts that I use to help ensure trend continuation. I'm going to skip one ahead because I'm going to show you something. Here is what kills options traders. This is what buries those 80% of options traders. They buy a stock, they take a bullish position on a stock that's in a strong uptrend. And then what happens in the course of the trade is the stock goes into consolidation, and the consolidation can last for months before it breaks out and resumes its bullish move up. Or the stock can go into retracement back to support. Now, at all times, from a technical standpoint, the stock remains bullish. It will stay above its 50-period moving average. It'll always stay above its 200. And many times it may stay above its 20-period moving average. But a retracement like this can also take months. And this is, at the end of the day, is why such a huge number of options traders lose money. The stock that they're looking at is in a technical uptrend, but the reason they can't avoid this consolidative phase or this retracement phase is there's no select stock catalyst, and that's fundamental analysis, to keep that stock moving up. And that's what I look for when I take my trades. So I'm going to go back now. I'm going to show you a couple of things that I look for. And this is really what takes all the work. And this is the work that most options traders do not want to bother doing. And I'm going to show you how I do it too. You have to look for insider buying, CEO and CFO, very large stock positions. Now, at the same time, the only thing that's different is you have to look for huge options trades. And that is the footprint of big money. Now, the difference between the CEO, CFO stock position change is they have to file a Form 4. It's a 4F. I can't remember the name of it, but these positions are published, and you know who is making the purchases or the sells. Here, they do not have to tell you the name of the person making the trade. But if somebody's willing to commit $250,000 to an options position, then you should take notice of it, because that's a large amount of money. Now, it might be placed by somebody who's worth $3 billion. But I'll tell you, the billionaires are probably, the biggest skinflints. They don't want to lose anything. So even if their net worth is huge, if they place a $250,000 options trade, they're going to want it to work. And that's what I look for. I'm going to show you the data feed that I use, but it's very important to follow the footprint of big money, not only in stocks, because these are catalysts. I just saw today that, I know I'm going to forget I forgot his name. Carl Icahn liquidated about 25% of his personal stake in a company, and I think it's Herbalife. So I have Herbalife on my on my watch list now to see how it's going to respond to the fact that I think he liquidated 15% of his positions, which was an enormous amount of money. So I'm going to see how that's going to respond. I mean, the stock may shake it off, but it very likely may take a hit. Now I'm going to want to see it go down a little bit before I make any move. But it's put that on my watch list. And anytime I see a huge options trade, I make sure that stock goes on my watch list as well. Now, there's a lot of small options trades that are going to cross the ticker. I'm going to show you my ticker. I don't look at put and call sweeps that are weeklies or that have a very short time frame. They're always risky. There are always traders who want to pay 25 cents and are looking for, 200 or 300%. And that's not the way I trade, because one of the things that I always look for is capital preservation. So I look for big options positions being placed at least a month out, sometimes 2 months, 3 months, even 6 months out. Those are the stocks I put on my watch list. Always look for FDA approvals. Now, usually once it happens, the stock just rockets. But sometimes, what will cross the ticker is the day that the stock is up in front of the FDA for approval or denial. And I'll show you last year, we made 100% in 20 minutes trading Gilead. You look for the unlock period, 90 days after an IPO. At the time of an IPO, a large number of insiders were holding large blocks of stock. 90 days later, they're allowed to sell it. Now I'm gonna show you how to trade the unlock period. It's a very, very nice uh, pattern that recurs over and over again. Then there's general esoteric news. And it could be, something really bad that happened overseas. And then the brokerage upgrades and downgrades. And one of the things that you actually look for the contrarian things, I think really mean the most to me. When I see a broker downgrade a stock and it doesn't fall, or a broker upgrade a stock and it doesn't go up, it tells you it's reaching its peak or it's reaching its bottom. So they both help you, but they may not help you in the way that you think. So, and there are other positions to avoid. And this slide is a little bit is a little old, but if you remember, Mylan Labs had that big problem with EpiPen, and they overpriced it, and it was in front of Congress. It was about a year and a half ago. Tarnished brands like EpiPen, and then after that we had Chipotle, which had E. coli in their hamburger meat. You have to wait for those stocks to repair themselves. Now, since that time, I've made a lot of money trading Chipotle, but you have to give the stock months sometimes to recover. And so you have to be very, very careful when you trade a damaged brand like this. And the other real thing that can really kill you is if you trade an ETF or a stock that has very small open interest. The difference between the bid and the ask is really, really large. And it just behaves very, very poorly. It's going to be hard to get in and it's going to be hard to get out. And in the course of the day, it's always hard to find the midpoint. And money makers or market makers are always switching the midpoint. So you'll see in the course of the day, 1 minute you're up a few $100s on the position, and then another minute you're down $200 on the position. And it really is of no bearing on the underlying movement of the stock. And so the market makers are simply moving the midpoint. So when other small investors get into it, they're going to pay as much as the market makers can squeeze them for. So as the midpoint rotates around, you're gonna see these positions change in value just dramatically. And I stay away from them like poison. Now, these are some of the best options traders in the world, and the reason they are is they publish their trades. And anybody who has the confidence to tell you what they're trading, I think is smart. The guys that tell you what they did a month ago, I don't want to know. But the Najarian brothers, there's John, I think there's Pete. They publish their trades and they cross the ticker, and I can see their trades. Mike Kuo, Carter Worth, Andrew Keene, David Tepper, Kevin Kelly, I see their trades. And I always take notice of them because there's nothing wrong with taking a trade that they take. Because what are they? They're big money. And they are also chasing big money. So if we can do what they do, because they're doing what we want to do, and that is chasing a stock for a lot of good fundamental reasons, we're going to mimic their trades. A lot of their trades that they take, I don't like, and I step aside on. But you have to do your own due diligence. But I like these guys because their trades cross the ticker, and I can see exactly what they're doing. Now I'm going to show you I want to show you some examples. And I don't want to spend too much time on them because I want to show you a lot about what's going on in my own portfolio and how we trade. Now, again, this is my own software. And yeah, the technical analysis on it has to be right. And what I look for are cluster purchases. Now, right here, this is an older position. This is a 2017 position. There were 4,200 calls purchased at the $20 strike. At this other blue line, there were 2,725 calls purchased, again at the 20 strike. So I moved in to buy it at the 20 strike. I mean, I might as well purchase it where everybody else is. And the Pulte position was a very long-term position. I believe we held it for 3 or 4 months, and it gave us a 98% return. Now, the thing is, it worked technically. It was in an uptrend. It stayed in an uptrend. It came back a little bit, but we got out with a 98% profit. And the reason it came on my radar screen was because we had almost 7,000 calls purchased at the $20 strike in a very, very short period of time. And that's a lot of money. And here's an example of CSX. 2,735 calls at the 38 strike. And then somebody else purchased more calls. So what I did was I bought the 37.38 call spread, and this was a debit spread. I wanted to be a little more conservative than these traders coming in at 2,735. We made 175% on this spread because it just rocketed up. Now, this is a risk reversal spread, and I don't do these very often because these are very, very risky because both legs of the spread are bullish legs. And you can lose a lot of money here, but you have unlimited downside and unlimited upside. And there were on the Qs 2,000 calls purchased at the 121 strike. I came in, I did the same thing, but I took a risk reversal trade on it. I sold puts and bought calls. So I have two bullish positions, and I use one to offset the cost of the other. And it skyrocketed, and it gave us 180%. All I'm doing here is the technical analysis works, and I'm watching what other traders are doing. The big money. And here's another one. This is one of the best trades I've had in a long time. And this is in 2017. This was iShares Mexico. Now, I don't know anything about what's going on in the Mexican economy, but there were just a huge number of calls purchased. 1,750 at the 40 strike, 1,211 at the 40 call strike. So I bought a risk reversal. I was so confident that I bought the 45 call and I sold the $40 put, which makes the price of the spread very inexpensive. But you've got two bullish positions. It went up to $1.25. We made 125, $1.25 per spread. That was 215% on MSCI Mexico. And I'll tell you something. I sold this too soon. This went up and up and up and up. It never stopped going up. I could have made 300 or 400% on this position. But once we hit 215%, we were nearing our expiration. And so I closed it out. Now, I haven't taken a risk reversal this year because this market is too volatile. If you really are sure a position is going to go in your direction, you can sell the puts to pay for the calls. So the price that you pay is cheap, but you've got no downside protection. And if this thing comes back at you, you can lose a lot of money. This was Weatherford, and the CEO of Halliburton was hired. I bought there were 5,400 calls at the $6 strike, and the stock and the position really languished. Now I'm going to end, I'm not going to go on and on with these because I can give you a million of them, but because I want to show you how to build these as opposed to show you examples. Now the options position was in a funk. It just didn't move on these calls. Then all of a sudden they hired the CFO of Halliburton. And in one day, it shot up to the stock pumped so high. This is 1, 2, 3 days. We made 109% on the position. We were out. And that shows how some kind of stock catalyst is going to fire up your options position. This is just FireEye, same example. Now these are on spread positions. Actually, these are out of the money call positions. I did those early in 2017. I haven't been doing them lately. And this is on Oclaro. We made 165% on this, simply because we had cluster purchases here, 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 and here. 10,000 calls, 516 calls, 908 calls. It just pushed the stock higher and higher. Somebody knew what was going on with Oclaro, and I just followed them. I was already in the position right here where this green arrow was, and Oclaro just kept going higher and higher. Now, this is a phase 3 trial. This is where we made, in 1 hour, the percentage is off. It's on Gilead. We made just under 100% in 1 hour. The night before, I put in a put order at $75. Oh, here it was. It was a $75 put for 31 cents. It executed in the morning, and we sold it an hour later at 61 cents. Just under 100% in 1 hour, based on the failed phase 3 trial. This was very lucky because I put this order in overnight, and it hit my 31 cents and sold at 61 cents, which is really a break. Another example is when stellar earnings sink a stock. I always look for that. I'm going to show you an example of a position we hold now where I did exactly the same thing. This is last year on Home Depot. I mean, it had great earnings, great forward-looking information. I mean, you know, they were looking at growth. Everything on the call was great on the earnings report. And the stock took a beating anyway. But then I started to see call buyers come in. 5,400 calls were purchased at the November 16, 124 price. I entered on the December 16, 125. And I closed the position up 90%. I love when a stock gets beaten up real badly with great earnings. You have to wait for it to fall and consolidate, then wait for somebody else first. Let them make the first move. Either you get an insider stock call, or you get a big call position placed by big money, and then you follow in. You know it's likely going to rise. So this is how I publish the trades. I'm gonna tell you to buy a bull call spread, say that the January 19, 2018, 140, 145 call spread, and I'm gonna give you the exact, I call it the net debit limit, the amount of money that you want to pay for it. I give you the exact entry, and then I'm gonna tell you the exact exit. I give you the net credit limit. And then the way I publish the results are, and this is what's very, very, it can be very confusing, or it can obfuscate the true results, because 70 cents per spread is 30%. So if I publish this as a percentage, it's a 30% rise. If I got 30%, say on a call on Amazon, this might be $3.75. So the percentage does not necessarily reflect how much you made on each position. Now, if the supposition is made that you're going to commit an exact same amount of money and you're going to make the same amount no matter what the percentage is, I think that's a big supposition. So I publish the results in two ways. One is the amount of absolute dollars you made per position and percentage per position. So the same thing with Chipotle. It was the 280, 287.5 call spread. I give you the exact amount to pay, and then when it's time, I give you the exact, price to close, 49%. Interactive brokers, I sold way too soon. If you see what interactive brokers are selling for now, you would choke. I think it's up to like 80 or 90. JB Hunt has been hitting 52-week highs all through 2018. I think it's selling for about $125. Home Depot, I'm not sure where that is. That's kind of fallen off my radar right now. We made 33%. So the number one goal in trading options is capital preservation. It's allocation of capital in a way that mitigates risk. And that's based on the spread position and on the position size. So don't worry about the Greeks too much. Don't worry about the mechanics of the option spreads. You're going to get that in options trading for dummies. Learn how to monitor stock catalysts and options catalysts and when to pull the trigger on a trade. Learn how to create a watch list and learn the science of capital preservation, which is really the key to profitability. This is why I have some would call it an aggressive portfolio. I'm going to show you the portfolio right now. I'm going to show you all the positions I hold right now in the portfolio. And I'm going to take this down, and I'm going to bring something else over here right now. Now this is Thinkorswim, and I'm just going to show you some of the technicals I look at. Now, this isn't our own software, but I thought it would be easier for you to see the technicals here than on our own software. Now you can see the high today on Microsoft was $99.99, and Microsoft is making new 52-week highs. Every time it goes up, it's making a new 52-week high. And if you look at Microsoft, you can see that what you have, whoops, hold on a second here. All right, let me just get rid of that. If you have a series of sequential higher lows, and you have, so what you really have here is a rising triangle. So what I did was, and it broke, I hope this is not too hard to see. It broke the top, and this is what I always look for. It retested the top, because you don't want to trade a breakout. You want to get a break, a retest of the top, and then a move up. So what I did was, now the cost of this position was only 60 cents. And it expires on June 15th. It's one of the few short-term positions that I'm looking for. And I'm looking for the 101 strike right here. Now, this was purchased almost entirely on technicals. And the fact that I've been watching Microsoft a long time, it really hasn't done much of a move. It broke its upper trend line, came back and tested it, and continued to move up. That's why we're holding Microsoft, and we're holding it at a profit. because it's closing in on that 101 strike at $101.60, or at break even at options expiration. If it gets there sooner, we'll break into the money. And I think we're profitable on it. I didn't check it right before I started, but that's the reason we hold this. And let me show you I want to show you a couple other positions that we hold. And I want to show you one that I bought totally on fundamental analysis. Nothing to do, and it's a very, very profitable position. And I'm going to show you ones that are not profitable. But most of what we hold right now are profitable. Let me find it. It's a very unusual ticker, and you're not going to see your normal options guy buy this, because it takes an enormous amount of research to get this position. The ticker's KSA. And I'm going to digress for a second. Now, what is this? This is the MSCI Saudi Arabian Stock Exchange. It's called the iShares Trust, iShares MSCI Saudi Arabia. Now look at what's going on with Saudi Arabia. And look what's happened in the last couple of days. The thing is going off the wall. Now, this is something that I caught early, and I'll tell you why I caught it. Now, what I saw here was I wanted it to retrace back to here, and this is where I bought it. Now, I'm not always as good, but we're going straight up on it. And this is purely, my entry was technical, but it's fundamental analysis. And what it is that at some point in 2018, Saudi Arabia is going to IPO about 80% of its oil infrastructure. Right now, it's all privately owned by the sheiks. They're going to turn it into a company, and they're going to put it on the Saudi Arabian Stock Exchange. That will increase the market cap of the Saudi Arabian Stock Exchange by threefold. So it's going to skyrocket the price of everything. And now that other traders are starting to figure it out, this is really starting to move. This has got a long, long way to go. I only bought calls on this position. This is not the kind of position I'm going to buy a spread on. And I bought the December 21, 2018 $31 calls. Now it's already trading at 31, and I paid less than $1 for this position. So we are moving up. I think we're up about 40% on it already. Our expiration is December of this year, and I believe this could be going for $40 or $50 a share on the exchange. That's what you get if you do a lot of homework. And let me show you the homework. I have to go here, but I want to show it to you. And if you come aboard, this is essentially what you're paying me for, not to have to do this, because it's an amazing amount of work. This has been Zynga Pro. It's $80 a month. It's not that expensive. But what it shows you is every single large options trade that crosses. It shows you every single insider trade. It shows you all the news. And I spend about 40 minutes a night running this ticker, looking for anything that I can latch on to that I think is going to help me. And you can see all the big options positions. Now, some of them are not that big, but anything that's reasonably big is going to cross this ticker. Now, there's an enormous amount of information here. And what you really have to do is, if you like a position, you have to keep a spreadsheet, because what you want to do is look for somebody else to come in with the same position. So it takes a lot of work, but this is really the key. It's just running this huge ticker. And this is how I got MSCI share Saudi Arabia. I saw the information cross that said that they were looking to IPO a majority of their oil infrastructure, and I immediately ran in and purchased those call positions. I think they could be one of the biggest positions, one of the most profitable positions we ever hold. So this is what you have to watch. This is how I got the MSCI shares Mexico. So this is for me, this is the key. Now I'm going to show you another position that we have in the portfolio that I use to hedge, and we just sold half of it, up 88%. And it is bonds. Now tilt is the 20-year. I wanted to buy the 30-year, but when stocks are really shaky, investors look to go into a more safe investment vehicle. And look what's happened to bonds since I got it. Now, I didn't buy it off its low, and I can't tell you exactly what the price is. I can tell you the position we have. So you can get an idea of where it was. I bought the 120 calls, and at the time, the position was slightly out of the money. I bought the July 120s, so it's got a month and a half left to go. I think there's a tremendous amount of upside left on bonds, and this is also going to be one rockin' position. I could not keep from selling half at 88%. I still have half my position, or my traders still have half of our positions, and we're going to let this go. But that is going to be another rocking position. And this is the kind of thing you have to think of. Where do traders go? I also have a position. This is why today we didn't lose that much money. I have a position on and I'll show you some of my losers too, or on wheat and precious metals. Now, in a market like this, you always want to hedge, and it's the June 15th that's coming up. It's the $20 calls, and you can see we're 21.65, and I paid very little for these calls. I can't tell you what, but this was not only technical. Oh my gosh, I'm so sorry. But also fundamental. Let me just get over here again. I can squeeze this a little bit. You can see how strong that of an uptrend that bonds were in. Right here. You see right here. You're going to come up to some resistance right around 22. I think it's going to pop right through. I can fix that, but I'm not going to try. You've got a rising triangle. I think this is going to go right through here. So that's another position. Let me show you one that is sort of not moving great. Now, I bought Netgear because there were a lot of insider traders, or a lot of calls purchased on Netgear. And I bought the 60-65 calls that are going to expire in 2 weeks. And you can see the position is definitely in an uptrend right here and right here. But it's sitting at its lower trend line. And if I spread this out, you're going to see that it's really consolidating. That's the options killer. Now, I need some catalyst to get this from 65 to say 63 or 64. It's just marginally down because it's between our two spread positions. But I need to get it higher. I would love to get it through 65, but I don't see it. And so this is one that's kind of languishing and it's giving me a little bit of a bellyache. And let me show you one more. I can show you one that's totally in the dumpster. We have one like that. Now I also have iShares Japan, which I bought on technical analysis. This is a great position to show you. HII. Now with defense stocks, like biotech stocks, you have to be very careful with them. You can really get beaten up on them. And I've had my lumps with defense. But you can see what happened. Remember I said I look for stocks that take a haircut on great earnings? Well, HII, which is Huntington Ingalls Industries, is the #1 world supplier to the US Navy of battleships, of all ships, destroyers. They make aircraft carriers. They make everything. Now, it looks like the price closed at 221.07. I have a 220, 230 spread. And it was just at 228. And now it's coming back down again. But you could see where I bought it. I bought it when it was in a period of consolidation. And I bought it after there were a lot of options purchases on it. And I liked it because this is a debit spread. This is a credit spread. The price of the calls were expensive, so we sold them. So I have 6 weeks to get this trade to 230. Now I think it's going to go, but I wanted you to see one in the defense industry. Now I just want you to again note, this is what makes the portfolio so powerful. I just showed you wheat and precious metals. I just showed you MSCI Saudi Arabia. I just showed you bonds. We also hold the Japanese yen. And we also hold our share of tech. I showed you Microsoft. Now, I tried to get into Cheniere Energy, and it ran away from me, but I still have the position in. Now, I have Apple, and Apple is doing nothing. And I may close Apple. Look what happened to it. It's moving sideways. It needs something to get it out of this funk. But you can see at the time I bought it, it was rocking. I thought it was just going to come down here and then continue up. Instead, it's just moving sideways. Now, we're not in the dumps on it. The Apple spread is a 185, 195 position, and Apple's at 186.85. But we're underwater on it. So we only have a couple of weeks. It's July, the month and a half to move it up. And then let me show you one that's completely underwater. In order for this to work, your thesis has to come through. Now, Albemarle is one of the biggest makers of zinc in the world. And what happened in Peru was that Peru increased the quota of allowable zinc production in the world. There's two big companies. There's this and Sociedad Química, two zinc producers. And look what it did to the price of this stock. It just took it into the toilet. So this is a spread that's going to expire worthless. We're going to take our maximum loss on this position because in the middle of the position, Peru announced an increase in the production of zinc. I still think that Albemarle is a great stock and it's going to stay on my list. Once it hits bottom, and I don't think it still has, I think it's still got a ways to go. I'm watching it right here. It just can't get out of its own way. And so it's a position I might move it into the future. Now I have a call spread on Xilinx that expires in 2019 in January. Xilinx is the number, I think Xilinx and NVIDIA are involved in artificial intelligence. And Xilinx right now did exactly what I anticipated. It moved up, but it's retraced. It's been retracing on this bad market. We've got such a long time to go on Xilinx that I'm not concerned about it. And that's pretty much, I'll show you our last position. We have one more, it's Bluebird Bio. And it actually hit our target, and I was so heady on it. It's really stupido. I didn't close out the position. And I'll show it to you. And I bought Bluebird Bio on the same reason, for the same reason. There were tons of call positions being placed. I mean, lots of them. And we have the 180, 190 spread. It's trading right now at, I have it at 180 exactly. And you can see it was above 190. It was trading at 193. It hit my price target. If you're in a spread and it's a 180, 190 spread, when it hits 190, no matter when it hits, you close the position. Now, we had a lot of time premium left on it, so I'm like, you know what? I'm going to hold because it's going to go to 200, then 210, and 220. If I would have closed it at the time, it would have made about 33% on the position. And I got a little bit greedy. And I said, I'm going to let it sit, and it's going to go up higher and higher. And it's retraced right back to 180. And I never should have let it sit. But I still think it's going to go up. And that's pretty much our portfolio. So everything is a mix of information and its technicals and fundamentals that I acquire from this massive data feed. But I've learned how to segregate it into options, insider trades, and you can filter it, and it has filters. And things like this, 44 stocks moving, is very, very helpful. The other thing that I like is somewhere in here, and I find it every day, is the most sought after stocks based on the ticker feed. So they go in and they see which stocks have been searched for the most. And if traders are searching for them a lot, they're on everyone's radar. And I look at that a lot. And that always pops out to me. They always have crypto information. I just bought EOS based on information from here. I have EOS. I have Litecoin. I have Ethereum. Really based on this. So this provides me with an enormous amount of information. Now I'm telling you, if you want to combine, and I'm really closing this now, because I'll go into questions, and I'll show you what the offer is. It's really cheap. If you want to combine technicals and fundamentals, here's the fundamentals. Here's what everyone's buying. Here's what everyone's interested in. Here's what the insiders are buying and selling. Win was a spread I just closed out last month. Man, the problem with a lot of the positions I have I closed them too soon. I think we had a 165, 175 spread, and Win is now at 195. So, go figure. But this is where I get all my information from. It's just a lot of data. And if you want to spend your evening going through this, then you're going to get the same information I get. Now, let me move this aside and this aside, and I'll show you the offer. Let me open this up, and then I'll take any questions. Now, let me tell you, all The sophistication and all the learning that you can get from a mentor you pay $5,000 for cannot provide you with better information than you get from this $80 data feed and from the technical analysis I do mostly off our own software, but just to demonstrate just off of using Thinkorswim. I mean, there's nothing better. And I personally don't think you need any better positions than spreads, occasional risk rewards, an occasional iron condor. But 95 to 99% of your trades, they only need to be debit spreads, credit spreads, calls, puts, occasional risk reversal. So the alert consists of, we get a flash alert. I'm going to email it to you on the spot, and I'm also going to text it to you. If you want to participate in that, all you have to do is give us your phone number, and we will send you an SMS text. Now, I was almost going to send out an SMS text on Bluebird Bio when it hit 192 to exit and give you an exact exit price, but I didn't. But I send out a lot of SMS text messages to buy things that have collapsed and to get you in at a great price. And I just want you to remember, I take every trade I recommend. And if you're part of the service, you're more than welcome to ask me for my account. Obviously, I'm going to redact the number of positions I take, and I'm going to redact out my account number. But you're going to see I take them all in Thinkorswim, every single position. I do a monthly review. And last year, I sent out about 300 alerts. That's an average of one a day. And what really happens is we'll go 2 or 3 days without an alert, and then the market will really pick up, and we'll get bang, bang, bang. Maybe Bluebird will hit, and a couple of others will hit, and we'll close out multiple positions, and we'll go into multiples. But we have a 15 position portfolio. So it just really depends on how the market moves. Now, the first month is only $9. And if you don't like it for any reason and you cancel before the 30 days is up, you get an instant refund. All you have to do is just send us an email to info@rightlinetrading.com and say, I subscribe to the options alert. I'd like a refund. If it's within 30 days, you get your money. No questions asked. You don't have to give us a reason. You can say you use it for cat litter and you don't like it. Just we will take it back. After that, we'll bill you $99. I want you to know up front, but you can still cancel anytime you want. If you cancel like on the 32nd day, you're not going to get the $99 back we won't bill you again. But in the first 30 days, it's really a risk-free trial. And the only reason we put in the $9 is so we don't get people who are just window shopping and don't really care. I mean, if you're interested enough to spend $9 on a no-risk offer, then we want to have you. So that's the only reason. We don't make any money on the $9, believe me. And like I said, if you don't like it, we're going to give it to you right back. So let me see if there are any questions. Hang on here. Okay, let me go through them. Okay. Larry, how many trades a week you can expect is really actually I skipped a few. Let me go. Yes, Bud, you'll have the recording. It'll be available. Like, you know what, Larry? Long-term options positions. I think the dollar is horrible. I would short the dollar. You see, I'm in bonds. I would definitely stay in bonds. I'm very bullish on gold, but I would not use the gold. I would not trade GLD. GLD and SLV are horrible. And what I would do is I would find a really good gold miner, or I would find a good gold stock, Like I wanted to leverage silver, so I used wheat and precious metals. Silver is only up a little bit, but wheat and precious metals is up a lot. I mean, we're up about 60 to 70% on that spread. So that's really what I like. I like gold. I like silver. I would short the dollar, and I like bonds. That's really where I'd look to be, and I'm in all of them. I haven't shorted the dollar, but I'm in the yen, which is sort of a way of shorting the dollar. It's the dollar yen cross, and the yen is doing very well. I didn't put it up, but I'm in the MSCI yen. Um, let me give you the ticker, and it is moving up. Moved up today, and it helped us out. It's the Guggenheim Currency Shares Japanese. It's the FXY. We have an 88 call spread, and it's at $88.03. It's at our strike. I just paid it. It's right now. It's selling for 85 cents. We paid very, very little for this. If it can just get to 89 or 88.50, we're going to make nice money on it. Okay. So Larry, the number of trades, it really all depends on the market. I look to keep the portfolio around 12 to 15 positions. If we blow out 2 or 3, I'm gonna look to refill it, because I like to keep it at that number, and I like to keep it diversified. If we have a lot of tech, I'm going to stay away from tech, and I'm gonna look into the sectors that we don't hold, and it's really been advantageous for us not to weight down the portfolio. It's so inviting to weight it down with tech, because tech, you got great volatility, and biotech is also very dangerous. I have one biotech, I Bluebird Bio, but I like to diversify. So some weeks you may get none, and other weeks you may get 5. It just all depends how the market behaves, and it depends on our strike and how the market goes. So I'm not going to give you any. I'm not going to take a set quota. All that matters to me is at the end of the year, I'm looking to get 100% return. That's my goal. I don't use a stop loss, Raj, and here's the reason why. Market makers eat them up alive. When they see a stop on an option, if it doesn't actually hit it, but you're close, they can just take it right away from you. I know a lot of traders will put a stop at 50%, and that's okay, but I've had way too many positions of mine come back. And a spread like Alba Marie just went to pieces in one day. I mean, the day that Peru announced their price, their quota increase, the spread just went to, Alba Marie dropped about 14 points. So if I would have had it wouldn't have helped me, believe me. So I don't place them, because I've had more bad luck with them than I've had good luck with them. So of the positions that don't work, we usually lose 100%. But I don't want you to scare you. We're looking to wager or to risk 50 cents to make $1 or $1.50. So the risk to reward is stacked so much in our favor that if we get 60 to 65% of our trades as winners, we're going to make good money. Last year we had 78% winners. So I'm not concerned about it. There's no auto trading, Larry. No. And that's because you have to monitor the ticker. You have to look at Zynga Pro every day. You have to see what people are buying and selling. An auto trader is going to take a position based purely on the technical analysis of a stock. But like I said, an auto trader could give you an entry on a great technical entry, but then the stock is going to consolidate, or it's going to retrace on you, and nothing can prevent that. It stays in bull mode, but it doesn't move for you. So you can't auto trade. I don't day trade options. I can tell you, I just don't do that. I mean, you can, but I don't. That's not the goal of this portfolio. The goal of this portfolio is to take 30 to 45 day, sometimes 60 day, and sometimes 8-month positions. And like MCI, Saudi Arabia is already in the money and is going nowhere but up and doesn't expire until December of this year. Xilinx doesn't expire until January of next year. I just have 2 long-term positions, and those are them. Most of the positions are 30 to 45 days. Oh, Jeff, everything is sent via email. Everything. We also send out the SMS text messages, if you just in case. So you're always going to get both. Don't worry about that. No, no. Um, I don't trade monthly. Well, oh yeah, I trade the monthly strike. That's correct. I don't trade the weeklies. Occasionally, I'll take a weekly strike, but I don't trade the weeklies. Like I'm not looking to enter a trade on Monday to close it on Friday. To me, I consider that hit or miss. I mean, I know that traders do it. Other traders, I know, they have services that trade deep out of the money spreads. So, you have a 15% cushion, but you're looking to make 25 cents and you're risking 75 cents. And I don't take those kind of trades. I've had bad experiences with those. And I'll tell you one really quickly. I had Walt Disney at a 105 strike, or the bottom position was 105, and it was on options expiration day, and somebody came out and downgraded the stock and trashed it and beat it to death on a Friday. And I wound up taking it, I took a beating on it because it was deeply out of the money. And I was right at the lower edge at 105. So I will not trade anything like that again. So I do trade the monthlies, yes. Bonds, I like TFT or TLT, Tilt. Tilt is the 20-year bond, but it mimics the 30-year bond almost exactly. So I'm in it right now. I have the 30-year iShares Tilt. It closed today at 121.03. We're in the July 120 calls. And I'll tell you, when the Julys expire, I may roll them over into August, because I see bonds strong throughout the summer. So we'll see how they go. They came back a lot yesterday, and I think they came back a little bit today, and they're going to retrace. I could have closed the position yesterday up 88%, and we gave back some money, but they're going to come back. Bonds are strong and steady. Guy, I've learned from experience, I almost always exit before earnings. Because let me tell you, those are the trades I have taken the worst beating on. I'll tell you, last year in 2017, of the 28% positions I lost on, the majority of them were holding through earnings. And stellar earnings, and the stock goes down anyway. And it takes your option, it takes your position out. If you're profitable on the position, or you're marginally in the red, I would just close going into earnings, because then it becomes a crapshoot. And I'll tell you, I had that with CVS. CVS had stellar earnings, great forward-looking recommendations, just major growth, and CVS took a big hit. And I was $1 or even 50 cents away from my upper price target. And all I did was read how CVS was going to do great earnings, and it did. And traders sold it off anyway. So I will not hold through earnings. Okay, I have to look. AVEO. Let me take a look. because I'm not familiar with it. I'm gonna put it in here. AVEO. I mean, honestly, to me, looks like it's got a problem because if you look at it, here's the pennant, and here's the move up. And what you would like to see from here is continued movement like this. That's the bull flag pattern. Now, I don't know where you purchased it, or you may just be considering it, but now this is a 180-day chart. It looks to me like it's just in consolidation. I don't see it unless you know of some major catalyst. Technically, it's not forming anything that I can look at here as being any kind of a bullish formation. I mean, and if you look at the MACD, it's crossed below the zero line. I don't put much weight in that, but I just don't see it as being anything that's going to skyrocket here. Volume 2 has been dropping. It's not increasing. So I'd be very careful about this. Unless you know something that I don't, from just looking at a chart of it, I don't see much here. Raj, that's up to you. I long since stopped giving out that advice. And what Raj asked for, what percentage of the portfolio do you allocate for each trade? What I do, Raj, is I allocate the same amount. I used to spend a lot of time trying to think, okay, this one's safer, this one's riskier, this one's not riskier. And you're never going to be able to do it. Every trade I recommend, I take with the maximum amount of safety. I believe they're going to be successful. So I equal weight everything that I trade. And I try to get the exact dollar figure invested in every position. So if ultimately it comes out to, like, trading a call and a half or a spread and a half or 10 spreads and a half, I'll average up, but I pretty much try to keep them equal. Okay. Tom, let me tell you why it performs well in a bear market. And it's because, first of all, we're still in a bull market. So I'm still looking to take long positions. But unlike most other options portfolios, I've taken defensive positions. And I can read them to you, which is why we didn't take a big beating today. I lost money today in my portfolio, but you'd be surprised how little. Just give me 1 second, because I'm a single dad here. My son just paged me. Let me just tell him I'm giving a lecture. So what we do is we hedge it, and again, I'll show you how we hedge it. And what we do is to keep us from taking a bath on a day like today. We have positions like the 30-year bond. I have the Japanese yen. I have silver wheaten. So we're in precious metals. I have Huntington Ingalls, which is the defense industry. I share Saudi Arabia. So the portfolio is well diversified, and that's how we keep from getting really hit in a big downdraft like today. Now today we lost money, but we could have lost a much bigger amount, because we had a lot of positions either flat or up, and those were bonds, the yen. That's how you do it. If you try to trade 100% tech, you're going to get massacred today. And you can see my little watch list here. I like Autodesk. There's Alba Marie. I like Amcor, Amazon, Alibaba, Salesforce.com. These are all positions I just like to watch. I love Raytheon. Raytheon's in consolidation right now. It's not tradable, but I really like Raytheon as defensive. I like Take-Two Interactive. I'm very bullish on the game makers. So, I just keep a watch list. That's how we stay out of trouble in a down day. I'll show you my list. Hang on a second. Oh, I'm sorry. Here. This is my watch list, though. This is AAOI, and you see what's happening here. This is flying. This is applied optoelectronics, and it's consolidating forever, doing nothing. I saw it skyrocket. It's not giving me an opportunity to get in. It just didn't lift off. It rocketed off. Now I needed to retrace, and then I'm going to go back in. And we're going to take a long position. And if you go back a long time on this position, it was very expensive. It was at 71 and came all the way down to the 30s. So it's in the optical industry, optical networks. It's in a great industry. It just got murdered. Reason it's on my list is stocks that have taken a haircut. But this did not give me any signal. And look at the volume. It just went nuts, crazy. And I saw no catalysts in Zynga to give me the heads up that this was going up. But it's on my list. And if I get a retracement, I'm taking it long. And I have Apple, which I'm in right now. Autodesk, which is taking a nice retracement. Alba Marie, which I told you is really dead. Amgen is the one biotech I like to look at. It's doing nothing. Amazon, always a great stock, but I need to come back. Alibaba, consolidation. Salesforce.com, consolidation. Freeport McMohan, I love the stock, but just not a position right here. So this is my watch list right here. Here's Home Depot. Here's Lowe's. Again, rocketed up. I'm waiting for it to come back. We're in Microsoft. I like Raytheon, and there's Take-Two Interactive. So these are and I got this list all from here. So I missed a huge opportunity on, it's not Wendy's, which was it? It was a small burger chain. God, people were buying it like crazy, and I just hesitated. It's up 100%, and I just can't remember which it is. It's not Wendy's. It's even smaller than Wendy's. Sometimes you miss them. And I'll just show you quickly. This will be the end. I'll show you Cheniere, which is Ling, is Ling. Whoops, I want to show it to you on Thinkorswim. I put in a position on Ling. I wanted to get it, but I was looking for a little bit of a pullback. It didn't give it to me. Let me find the ticker. I thought it was Ling. And I'm still waiting for it to come back to my buy price. I don't chase anything up. It's LNG. LNG. See Cheniere? It's gone. Now the information I got that there's a tremendous. You see the order I have? I have an order to buy 9 positions. It's still sitting there. I just missed getting in. It came down here, and And those louses called market makers would not would not fill my order. And what did it do? It's gone straight up. So you see exactly what's sitting there waiting. I told you I had an open order, and there it is. What is the information? Is that Russia has a severe shortage of liquefied natural gas, and they are going all out hiring tankers to bring over liquefied gas right now, and that shortage is going to last quite some time, and it's going to take Cheniere up a lot. Only I have a really severe problem with chasing this up because I don't want to hit it in a retracement. So I'm going to leave my price here, and if it ever comes back, I'll just let it sit. And if I don't get it, it's a missed position. That's all. I'm not going to pry over it. But you can see it's still sitting there, waiting to go. Okay, you want RRC, Eric? Now, RRC, that is Range Resources. You know, let me tell you, I mean, Range Resources definitely has potential here. But what it's got to do is just break out of here. I mean, I would wait for Range Resources to break out of 1638, up, retest, and up. I mean, I think that, that's where you are with Range, but I like it. I mean, this is a definite nice rising channel. It's making sequential higher lows, sequential higher highs. It's pulled back though and broken that uptrend. So now it has to reestablish. And the only way it can do it is by breaking that high here. And then it's got to retest it. But right around 1628, I would start sniffing around real carefully. But don't take a false breakout. That first breakout can go nowhere, and it come right back and break through support. Let it test support, head back up again, and then right around 1650, 1660, you can either place an options position, an option spread, or potentially buy the stock. I mean, I would consider that, and I like everything about it, actually, to tell you the truth. It's a really nice pick, and I'm going to put it on my list. I'm going to steal it from you because I like it. I mean, it's definitely has potential. So thank you. So listen, that's it. I hope you'll come aboard. It's no risk. It's $9. And if you don't like the service, if I don't give you winning trades, I don't make you money. You can paper trade it for the 1 month that you have the trial. And I'm very careful with my positions. We just sold half of our tilt position, our bond position, 88%. That would have paid for, if you had a couple of call positions, that would have paid for 6 months of the newsletter. So I hope you'll come aboard and test it out. So listen, everyone, have a great evening, and I hope to see you aboard. Take care and best of luck, and we'll send you the recording. Have a nice evening, everybody. Bye-bye.